all the time.
Hmm.
So
Yeah, it's interesting. I saw today online, New York is the only state that is 100% all in school, which would have been unthinkable, in the
yeah.
spring. So, but well, hey everyone, this is Rich Swerbinsky with the Mortgage Collaborative. Kate and I are just catching up on our kids and remote or in-person school, and we're going to get started here in a moment. See some people still popping on, and we'll get started in just a few seconds here. So,
So Rich, how is the weather? You're still warm there, warm there, right?
oh my God, the weather this summer has been awesome in Cleveland. Like it has been since Memorial Day, like 80 and sunny with no humidity and very little rain, like most days. I mean, it has really been the best weather spring and summer I can remember in Cleveland.
We can at least thank Mother Nature for nice weather during
Something,
the
yeah,
pandemic.
honestly. Right. All right. Hey, everyone. This is Rich Swerbinsky with the Mortgage Collaborative. I want to thank everyone for tuning in for the last week in mortgage today, our weekly whirlwind through all things happening in the ever-changing mortgage industry. Back once again to co-host with me is the CEO of Eustace Mortgage, Kate deKay. Kate,
What's
thanks for
up,
joining me
Keith?
again.
No problem.
Awesome. Kate, the first to get the repeat invite for the co-host slot. So must mean you did great last time. So
That's what we're saying.
absolutely. So well, thanks again, Kate, for stepping up and answering the bell. And so let's go ahead and get started. I want to get started with today's episode, talking about maybe not some new news, the Fannie Freddie 50 basis point refinance fee,
Yeah.
which was delayed to December 1 fundings and beyond. But what I wanted to pick your brain on, I'm starting to hear just some talk back and forth between our members, and is the timing on, I guess, when you will re-implement that into your rate sheet. So I'll just start with that question.
Yeah, so we're actually looking at probably close to September 15th. We've been kind of monitoring where investors are going to fall on loan delivery dates and purchase dates. So far, it's kind of been November 9th, delivery, purchase by November 20th. Refi is churning about 40 days at the moment. So that puts us right here at kind of the crunch time to start putting it back in pricing here in the next 2 weeks. So initially I had thought, October 1st, when we started kind of paying more attention at the end of last week, it seems like we're approaching it here mid-September.
Yeah, I kind of figured October 1-ish time frame, but then with how busy it is, number one, if you deliver to the aggregators, you got some extra lag time there.
Yeah, they're taking longer, we're taking longer, he's taking longer. So you just don't, that October 1st snuck up on us for sure. You had to move it up a little bit closer.
And for all our attendees, would love if you could pop in the chat or when you guys are thinking about re-implementing that fee into your rate sheets. Just curious. Yeah, and the other factor too that I was talking to a member about this morning is just, I guess, expected more refi volume, like people that, like a lot of lenders are going to be marketing, right? Hey, get your refinance in now before, rates go up because of this fee. So that's probably going to lead to more volume, in theory, longer turn times. So
I think it's all about capacity right now for everybody. I mean, loan officers can only get to so many people in a day. So whereas we didn't really use it as a marketing tool, we didn't really talk about it when it hit. We didn't really talk about it when it went away, since we knew it was kind of very short-term problem, meaning it was going to come right back. So we're not going to sit there and push out, come refinance now. Refinancing for the most part for folks is still going to make a ton of sense. So we've not really used it as a marketing tool. Now, on the flip side, I know our loan officers are going to get, anybody that may have been on the fence, kind of not quite ready to lock, they'll definitely get all their locks in. Whether or not it has this big boom right before things turn, I'm not so sure that we're going to see that. I think refinances are here for a little bit longer, and we'll still see them once the 50-bit fee comes into play again.
Purchase volume, any let up at your shop?
No,
New purchase apps?
No, we're still, so we've been kind of about 55, we've been about 60/40, 55/45 purchase to refi. So we're still heavy purchase. I mean, we never really let up on the purchase front much, though. I don't know if it was just our particular areas or what the case was, but we've still stayed strong and remained strong on apps for purchase business.
Yeah, I think last month TMC benchmark, if I remember correctly, this was new apps for the previous month. I think it was like 58% purchase, but it was like 42% purchase like 4 months earlier. Had slowly been trending up. So it seems like we're moving from like 40%, 40/60 purchase to 60/40 purchase is probably where the industry is at. Have you seen any changes in your mix of Govy conventional over the course of the last few months?
No, we've kind of been right at the same, about 55/45 conventional to Govy.
Yeah, and that's what we've seen. I mean, you guys do a lot more Govy, luckily for your profit margins than most lenders, but I think TMC benchmark 21, 22% Govy. It was up from like 18% was the lowest it dropped when I think people were a little freaked out about getting their loans purchased and
Right.
forbearance and all that. So
Yeah.
it's just kind of pushing people more to conventional, but
For sure. And we stayed, even during that time, of course, it was a little bit more risk there, but we stayed fairly heavy government, tried to limit our overlays as much as possible on that business. And it's still strong.
good. So I see Ken Wells from Escoma Bank put in the chat, they never removed the fee. We would have had to change again in 2 weeks. Didn't want to create that confusion. I definitely have heard that from lenders. So anybody else that is listening in, we had asked at the outset of the call when you're going to re-implement, if you ever took it out, the 50 basis point refi fee back into your rate sheet and any expected impact from that. So I have seen
I've heard a lot of people, Rich, say just with Kenneth did, which is that they just never removed it in the first place. And I know some people kind of went back on their locks that happened in that window of time that we did lock with the 50 bips. We tried to just simplify it as much as possible with all the everything else that we all have going on. Again, it's about capacity and our people's ability to do their job successfully. And we thought going backwards on the locks that we had during that period may not make sense. Do it when we need to, but we did remove it for the few weeks that we were able to.
I mean, I got to be honest with you. If I was still a lender, and because we had this was part of the discussion last week. Like, do you go back on all your locks that were locked with the fee and then remove it? And I mean, you can't even imagine how many times fees are hoisted upon mortgage lenders with no notice, and the madness in busy times, like you said, of just trying to go back and do that. So.
Yeah, to try to redisclose that number of loans, of course, case by case. Somebody's appraisal comes in low or something happens, and there's a 50 bip change, then it's an easy offset for us. So, you just don't keep moving forward with that lock, don't make any adjustments. But to try to go back and redisclose all of those loans and remove the fee when we know it's coming back anyway here soon enough. And we did have loans that the market did react immediately. So we bulk bid and all of those loans got hit with the 50 bip fee. Now we are seeing in the majority of our investors coming back and actually refunding that 50 bips. But during the time that we were making the decision not to go backwards and adjust that 50 bips, you don't know what the market and what investors are going to do.
Well, good segue to the same crappy topic of fees being hoisted upon mortgage lenders. But a lot of talk this past week just about I think it was Fannie and Freddie, or Fannie or Freddie, that came out and kind of made a statement. Calabria's desire to recapitalize and release the GSEs. The agencies came out and said, hey, listen, that will lead to higher guarantee fees. I remember back in my old secondary days where you could actually negotiate a G fee at one point down to like 17 basis points. And I don't know if anybody in the listening knows, like, if anybody's done any kind of analysis on the implied G fee in your agency cash pricing. I've heard like mid 50s currently, maybe even a little bit higher. But the talk, what the agencies came out and said is that would increase guarantee fees by about 20 basis points. So on all loans. So, Kate, I'm just curious, like you're as the CEO of an independent mortgage bank, like your whole take on the GSEs, private versus public, like
Yeah.
what are you like cheering for at the end of the day?
Well, I'm kind of neutral in most situations, and I remain neutral on this one just because ultimately I feel like Fannie and Freddie are going to be, majority players in the game, regardless of if they're under conservatorship or not. I don't think it necessarily opens up this big private market if they get out of conservatorship. And the trouble with me with all of it is, one party starts the direction that they want, but inevitably can't finish out what they're going to try to finish out before the next party comes in. And in the upcoming election, of course, it's an unknown which party is going to come in. But even if Trump does come back in, I don't see that just timing as to what they have to accomplish over that period of time. I just don't see that they're going to be able to get out of conservatorship before the next go around. And then again, you just don't know what's going to happen. And each party has such opposite beliefs on what should happen. I'm kind of in between again on what should happen. I feel like government's making money off of Fannie and Freddie right now, substantially. I think $115 billion is what they made after, everything was paid off. The risk to them, I'm not so sure the amount of money that they are going to earn off of Fannie and Freddie, which of course has ended because they're allowing them to retain their profit to kind of hit the levels that they need to be capitalized correctly. So I'm just not so sure just if they'll be able to accomplish it in the long run or not. And I'm not partial to either or happening because I still think Fannie and Freddie will be major players even if they do exit conservatorship.
It's going to be interesting. And yeah, like you said, I mean, it's clearly the election's going to drive the direction, but there still may be nothing that happens.
Right.
And, I think that, think about it. You said it was like over $100 billion in Fannie and Freddie profits have been swept into the Treasury coffers. That's
Yeah.
a tough faucet to turn off. And, if you look at I don't look at the national polls on the election. I look at like the Vegas future markets, like where you can bet on it. And it's like a coin flip right now
Right.
on the election. I know that the national polls have Biden up, but if, you want to actually place a wager on it, it's close to a coin flip.
Yeah.
It's going to be very interesting to see what happens. My sense is that if Biden wins, that the agencies will stay in conservatorship for sure.
Mm-hmm.
If Trump wins, I think they're clearly going down the path of trying to privatize the GSEs. If they're going to be able to or not, we'll see. But
well, and I think too, with the increase in the G fee, like you said, I think it is inevitable because they're trying to capitalize to be able to privatize in the first place. Which, if we see too big of an increase, will push more loans back to FHA loans, which just will increase the government's backing of mortgages in the first place. And again, as we all talk about, FHA's kind of become the lower end loans to begin with, and more of the quote unquote our new subprime to begin with. So it'll be interesting to see if that does occur. Does it adjust more loans back over to FHA?
Dangerous game to play. Like right now, volume is robust. Mortgage lenders are making great margins. But think about a more normal climate. You've now implemented a 50 basis point fee on all refinance transactions. If Trump is reelected, you're almost certainly going to have another 20 basis points added to all lenders' guarantee fees, which is directly reflected in the cash pricing that ultimately determines your mortgage rates. And you already talk about home affordability, values shooting up right now. Obviously all the impacts to the economy from the pandemic, like it just, it seems easy to layer these fees on right now when times are good for mortgage lenders and for the housing economy as a whole, but dangerous game to play.
For sure. And I mean, right when that 50-bit fee came out, I mean, my first thought was, wow, that's a quick money grab.
Yeah.
Government sees what's happening. They're like, we're going to get some of this. So I see that continuing to escalate. Again, if Biden comes in, it's not going to escalate. I don't see anything happening before the election at this point because both sides have too, the current party in control has too much to lose if they were to do more. But for sure, I see more of that coming down the line as they can, especially with the market that we're in right now.
I mean, I don't have a calculator in front of me, but most people are projecting next year, I don't know, a little under 3 trillion in mortgage volume. Roughly 50% of all loans that are originated go to the GSEs. Let's
Yeah.
just for argument's sake say 40% of all those loans are refinances times $1,400 or 50 basis points per loan. That's an astronomical number.
Yeah.
So interesting.
Good to be able to make the rules and change things whenever you want.
Oh my God. It's like, yeah, that's an easy way to generate just like billions and billions and billions of dollars.
Right.
But,
I think the bad part is, and I didn't get to fact check myself, but from memory, the funds that we generate, Fannie and Freddie generate, GPs generate, they're not earmarked towards anything. So that's the only thing I'm not a super fan of. The government, they can just kind of choose whatever, nothing that may impact housing, nothing that betters anything that we may be advocating for. And it just, goes to whatever the latest bill is. So
that's a great point. It's a tax on all, everybody that is buying or refinancing a home that doesn't have to go through Congress.
right.
They're able to just lop basis points on GP or delivery fees. Doesn't have to get any approval from anyone in elected representatives of Congress. It's a great point. And your point from earlier is another great one too, is, you keep doing this and what's going to happen is more and more volume, and especially the volume that is not the cream puff volume, is going to get moved to FHA. In theory, that's going to make that book perform worse.
Yeah.
The government obviously is on the hook for insuring those loans, and it's definitely a tightrope to walk. But right now they are just lopping the fees on, and it's I don't think like Joe American, they've heard about the refi fee. They have no clue like the dollars that are involved in decisions like this and how it just has no checks and balances at all.
No, and what was funny was, of course, NBA did a great job at getting it reversed, and they kind of came out with, just like you talked about, it's about $1,400 more per loan. Well, of course, CEOs from Fannie and Freddie come back out and they say, basically try to debunk everything that NBA is advocating for, and it's it's just not saving the borrower as much. And it's just thinking, well, exactly, that means it's costing them $1,400 more, regardless if it means they're not saving as much. That's money out of their pockets, and worse for the environment that we're in. Although it's interesting and hard for me. I read an article earlier today. I can't remember. I think it was in Housing Wire, and it was called was it Bloom or Gloom? Boom and Gloom, and it was just the extreme opposites. And I've been talking about this for a little while. The extreme opposites that we're seeing in the housing market right now, because we're seeing a boom. People are purchasing houses all over. They need a bigger space. They need a different space for remote working out of their homes. They want a second home. People trying to move kind of away from cities. That's all a boom. But then you look on the flip side of renters and what's happening with investors and investment properties and renters. Those are the ones that are most affected by what's happening right now, where we're seeing kind of the complete flip side of it and the positive effects that it's having on housing.
Very true. Everything that's happened related to the economy with the pandemic, it is helping increase the divide between the haves and the have-nots. If you look at the employment statistics, typically people over 40 that have had stable jobs, the employment has been impacted so much less than people between age 21 and 35, people in the service industry. And then, we've seen the same thing with the housing market as well. Like, sales of big homes are performing incredibly well. Suburbs, growth, but the lower end is kind of getting hit. And one of many still to be determined, like long-term impacts of the pandemic. So, but we could be sitting here honestly a year from now, I really believe it, and looking at some issues related to home affordability and the lower end of the housing market that issues that had already prevailed that could be made much worse by what's been going on. So
Yeah.
we got about 7 or 8 minutes left. I want to
Okay.
remind everybody, any questions, comments, anybody has, keep them in the, feel free to put them in the chat or the Q&A. We'll voice them line, anything you want to talk about. The one thing I wanted to hit on though with you, Kate, is just e-closings in general. Has been, a lot of talk around that as of late. We've seen some progress with remote online notarization legislation. States that didn't allow it are either now you can do it, or it's kind of being fast tracked through the state legislation. But it seems like, the biggest remaining holdup on this really is two things. One is just the current climate. It's so freaking busy right now, like changing any processes. I've just talked to a lot of lenders like, yeah, I would love to be fully, I can't get around it. And the other is, creating an e-vault or a digital wallet that an e-note can be placed into and then delivered out of. So where are you guys? I know you guys have been doing hybrids for a while. Where are you guys at currently with e-closings, and what are your thoughts on this matter?
Well, we're still implementing, which means that, just like you said, and unfortunately, like I've said 10 times during this conversation about capacity, we just don't have the capacity to concentrate on it. So it's just one of those things that's sitting there taking forever to finish rolling out. To me, so of course I read the article, I'm sure just like most people did, that said the lenders are the reason that this remote online notarization is not finished out yet. And I think that's a bunch of BS. The eVault was probably the easiest thing that we kind of encountered throughout the process. Most of our warehouse providers have the eVault ready. So I don't see that, and I didn't see that as being the holdup at all. Of course, way back it was more across the lines of all investors taking it. And then of course, always the issue of the states and the different requirements in each state. And that the states is, to me, the states are still the biggest holdup, because of course investors have all kind of gotten there at this point. Warehouse banks are ready, eVaults are ready, MERS is there. So it's all lining up, but state specific rules are still not able to do a full RON closing.
Yeah, really at this point, right? The main secondary market aggregators and the warehouse lenders, they're pretty much all on board with it, right?
Yeah.
Okay. So I think I read the same column as you that kind of mentioned that.
Maybe the lenders.
Right. Right.
Which I was agitated about. I don't see that as being the case at all. So I wasn't sure what the specific direction or motive was behind the article, but I still see it as being a state specific issue.
I remember, God, I've been with TMC now for 5.5, almost 6 years. When I first took this job, I remember like, oh my God, e-closings full. They're like coming, like it's like 2017 is the year. Oh no, wait, 2018 is the year. Here we are going in 2021 and still not quite there for different reasons, but still not there.
Yeah, I spoke to a title attorney, and I think it's very specific too as to like kind of what title attorneys have control over in the states. I spoke to one, it's definitely been a few months at this point, but just kind of at the early stages of the pandemic, talking to them about, hey, this would be a great time to have Ron available. And, that specific attorney went into detail about why they think it's bad for them, which of course it's, about the business and do they lose the business and how do they maintain it, or more so the Quickens and whatnot of the world that'll just start utilizing, some preferred person and not be able to localize it here, in the areas that the loans are happening or the purchases are happening. So I think it has a lot to do with too, the title attorneys and their kind of backing in the state as to how quickly that'll roll through.
Interesting. One other topic I wanted to pick your brain on, because you, like a lot of our IMB CEOs, had a career coming up in the production side of the business, and just the whole real estate side of the residential lending industry, the real estate brokerages. It seems as if virtual showings and just in general, what are your thoughts on like the human realtor and, if you could fast forward 5 years from now to what, you know, Berkshire Hathaway or Keller Williams or Remax real estate infrastructure is going to look like. What direction do you think that's going?
Yeah. It's funny because I think my opinion changes on that a good bit depending on what's happening. And at first with the pandemic, I thought for sure that's the direction that we're moving, more virtual, potentially some sort of modified, because I've been saying there's got to be some sort of modification to the real estate agent, the commissions that the real estate agent makes, and kind of their role in the transaction. But when you continue to see like iBuyers and kind of the stuff that's trying to come into the market and disrupt the market back out when things go wrong, that's when you know that that kind of role is not really going to change. And although I think they're have adapted very quickly to being able to do more things remotely, so kind of do virtual showings and adjust their business model, just like we adjusted our business model to go with what's happening in the world right now. I think that their general role in the transaction is going to look pretty much the same for a good while now.
What
They
about the
just adjust
commission
their
side?
business.
I mean, just me, like in the common sense part of me, you know, like $300,000 home, with how much of the home searching and buying process is now done online.
I know.
Does it make sense on a $300,000 home to pay $20,000 in commissions to realtors on both sides of the transaction? And maybe what the
It
future of
doesn't.
that looks like. I mean, to me, it seems crazy,
It
right?
does, but I guess NAR really has does a good job for them because I don't know. I don't see it's not talked about. You know, things will come out here and there, but it's just like, you know, when Amazon says they're coming into mortgage and all of us get a little bit on our toes for a minute and then we realize nothing, but everything's going to be okay. It's kind of business as usual. I don't know that model is going to change, but I completely agree. To me, it's extensive for the amount that of commission that's on both sides versus what the person can kind of do on their own these days. But it's
Yeah,
not focused on for some reason.
yeah, and I think you're right. You give the credit to National Association of Realtors that has done a really, really great job representing that industry, not just through policies like that that are protecting the realtors, but just branding realtors in general. Like, the way they brand the human realtor in TV commercials. And to me, it's effective, how they're doing it. And again, same thing, just like we were talking 5 years about e-closings. I was sitting here 5 years ago saying like the human realtor is going to be completely diminished 5 years from now. And no, not at all. So, too funny. Well, we've reached the bottom of the hour. We like to keep these to 30 minutes to be respectful of people's time, but great conversation, a lot of great topics. Kate, always enjoy talking about the industry with you. And thank you for joining me again this week.
All right, Rich. Bye, everybody.
Awesome. Yes, and to all our attendees, thank you for taking some time out with us this week. Every week, same place, same time, 2:00 Eastern on Tuesdays. So thanks and have a great afternoon, everyone. Take care.